Hello friends, in this video we are going to talk about 3 beaten down companies. All these 3 companies are fundamentally very strong, but currently due to temporary reason these companies are down from their top. The discount available on these 3 companies is very huge. It's close to 30 to 40%. That's why now the risk in this company is very less because the downfall is very limited and the chances of these companies recovering from these levels are very high. So overall the risk currently in these companies is less and the possibility of reward is more. So let's start. Our first company is Jubilant FoodWorks and this is currently trading at 500 rupees. If I look at 1 year return, it has provided negative return of 33%. If I look at 5 year return, then the story changes. It has provided 161% return to its shareholders. And this is currently available at around 43% discount from its top. And this company most of you must be aware of. This company has the franchise of Domino's Pizza and Dunkin' Donuts. And in India, this is the largest food service company. And recently company has also launched its first homegrown brand, which is Hong's Kitchen, which is basically into Chinese cuisine as the name suggests. And this company is also the largest franchise of Domino's brand outside of USA. And Jubilant FoodWorks also has exclusive right for Domino's brand in countries like Sri Lanka, Bangladesh and Nepal as well. And in March 2021, the company entered into a master franchise agreement for Popeye brand. Popeye is a restaurant brand like KFC. And company has future expansion plan as well. Company plans on setting up 3000 Domino's stores and 250 to 300 Popeye stores in India, which ultimately is going to increase company's revenue. And Domino's is very rapidly expanding in tier 2, tier 3 cities as well, the benefit of which you're going to see in the coming years. Now, if I look at the recent quarterly results, there has been no problem in the quarterly result. You can see that the sales have been increasing and the profit of the company has also been increasing. So in September 2022, sales were around 1300, which in last year in the same quarter was around 1100, and the profit increased to 312 crores, which was 287 crore in the last year quarter. Although you see a dip in the OPM, which is operating profit margin, last year the operating profit margin was 26%, which has reduced to 24% this year, and the reason we all know, inflation, which is a temporary issue. Now if I look at the yearly numbers also, you will see that in March 2019 the sales were around 3500, it increased to 3900 in March 2020, then it decreased because of the COVID, then again it recovered and it went till 4300 levels, and now in the 12 trailing months it is again showing an increased sign and it is close to 5000 crores. And profit also, if you'll see, in March 2019 it was just 600 crores, which increased to 883 crores. In 2021 there was a dip and the profit was 780 crores. In March 2021 again it increased to 1100, and now in the 12 trailing months it is close to 1200. The profit in the 12 trailing months is little less because of the OPM, but in the coming quarters or years the company will definitely recover from it, and currently this company is providing opportunity, plus we have discussed that the risk and reward ratio is also very favorable. Now I am at the chart for Jubilant Food and you can see that the company made a low at around 450 levels, and it is currently very close to 450. It has now dipped to 500 rupees level. This level also is a very good entry level in case you want to enter into the stock, because this has been the company's support earlier as well. You can see the company stock bounced back from these level earlier. You can enter right now as well, or in case you get the opportunity again and if it falls further to 450 rupees, then also you can do more adding or you can enter at that point of time. So a great business, great franchise. I personally don't think that in India people are going to stop eating pizza. The percentage of youth that we have in the population are getting more and more habitual of eating outside food. So this is a good company. You can keep focus on this share. Next company is SBI Cards, and if I look at 1 year return, it has provided negative return of 16%. 5 year return has been in negative 24%. And if I look at the discount percentage from the top, this is currently available at a 32% discount. And this company has been little unlucky from the time it got listed. It got listed during the COVID time and it went down till 500 levels. From there it recovered, but whenever it was touching around 1100 1200 mark, there was a big fund house which was selling its stake and exiting from the company. But that does not make this company a bad company just because one fund house is exiting. I'm at the shareholding pattern and you can see since the time it was listed, since then FIIs and DIIs both have increased their stakes. So FII were around 4% and DIIs were also around 4%, and now if you'll see, FIIs are around 8.8% and DIIs are around 17%. So FIIs and DIIs are invested in this company. The public is very less, it's just 4.8%. Why? Because public think of short term. In the short term, this company has till now not given very good returns. That's why nobody wants to stick with this company. But what we need to understand is the business. Is the business bad? Not at all. The company is one of the leading lenders of credit cards. And here you can see the profit of the company. The profit compounding of the company has been beautiful. In the 12 trailing months, it has increased its profit by 100%. In last 3 years, it has increased by 23%. In last 5 years, it has increased by 34%. So with the profit, you can see that the company is doing very well. There is no issue with company's business. And if you look at the sales growth also has been very healthy. So the business of the company is good. There is no issue in that. Plus, this is currently available at a very big. Plus, this is currently available at a 32% discount. And now we are at the chart for SBI Card, and you can see that it is currently trading at 770. There are chances that it might recover from here, but in case market gives more opportunity and if it goes further down, then around 710 rupees we have a support. And in case if there is some big political issue in the world, and if you get it further down to around 650, then it will be an amazing level to enter into a good company. But do remember, if you are planning to invest in this company, your investment horizon should be minimum 5 years, because these company might give you a pullback in 6 months, or they might give you a pullback after 2 years also, or 3 years also. But if you will give them 5 years time, the business of the company is good, the profit compounding is good, and eventually the profit compounding is going to reflect in the stock price compounding as well. So you can focus on this share as well. Our next share is Dr. Lal PathLabs, and this is also one company which nobody wants to look at. Nobody wants to invest in this company because it is down from its top by around 40%. And most of the people are thinking that this company is not going to recover from this. And that is the reason, my friend, most of the new retail investors do not make money also in stock market. Because we generally like companies which make new highs, which are only going in the upward direction. But those companies will also not keep going in the same direction for a long time. They will also come down and provide either a time correction or a price correction. And this company is India's leading diagnostic service brand, which is doing a lot of expansion and acquisition to increase its business. And while I'm making a video, I just received a recent feed which says that the director of the company has acquired 35,000 equity shares worth rupees 3.50 lakhs. So the directors of the company, the internal people of the company, are investing in this company. But obviously that does not mean that we should also invest. We need to do our own research and see if the company business is good, and then only invest in this company. Now I'm at the yearly numbers, and you can see that in March 2019 the sales were around 1200, which increased to 1300 in 2020, which increased to 1580 in 2021, which increased to 2000 in 2022. And now in the 12 trailing month it is again almost flat, and the reason is simple, because earlier company was benefiting more from the test related to COVID, which has now dropped, and that's why you see a dip in the comparison between previous years. But the company's normal business, which was there before COVID also, it's still doing very well, and in the coming quarters and years you will see this company going up again. Now I'm at the shareholding pattern, and you can see that the promoter holds around 55% stake in the company, and FI also hold a very good stake around 23%, which is a positive sign for an investor, because you can see that FIs are invested in this company even when the company has fallen by 40%. They are sticking with the company. Why? Because they know this is a temporary issue. The company is going to recover. The company business is strong. The fundamentals are strong, and you can see that the DIs are also around 6.27%, and public is around 14.84%. Now I'm at the chart for Dr. Lal PathLabs, and you can see that this share is currently taking support at this level. This was its resistance earlier, and it is again back to its support. So this is the support level currently for this company. In case it falls to 2000 level again, then the risk will decrease even further, and the possibility of the reward will going to increase. So you can keep focus on this share as well. But again, before closing this video, I want to say, please do your own research as well. And in case you are taking a decision to invest, do keep your horizon to 5 years.